So welcome everyone to this morning's Innovation Bay Wednesday morning event series. I'm your host as ever, Ian Gardner. I'm a co-founder here at Innovation Bay. I'm also a VC, an investment partner with Gelix Ventures. Also on the team, Faden Stow is my co-founder. We've got Claire, Sam, CJ and Alison. So we're all here working hard to support and connect the startup community across Australia. There's a few people who are probably new on the line here, so welcome everyone, but especially the newbies. If you don't know us, we are the longest running community for founders and investors across Australia. Our mission is really to support founders on the journey from idea to IPO and beyond. And we're doing this through a range of events, programs, content designed to allow you and the other founders to connect, learn and grow. So we're using Hopin. Many of you may have seen it before. It's a little bit like Zoom, but with some frills, which we love. This is the main stage. We'll be doing the presentations from here. Once we finish the main part of the event, we're going to move into some breakout sessions, which we'll talk about in a sec, and there'll be some networking open as well, so you can participate in the breakout sessions or try some one-on-one networking, which is quite a lot of fun. In the breakout rooms, I think there's up to 9 people can participate on video, and everyone else can just watch, and hopefully some spaces might free up if you really want to get in. So it's pretty cool. We'll get into that afterwards. We couldn't do any of this without our sponsors, so thank you so much. AWS, IAG, Farmark Ventures, KPMG's High Growth Ventures, and Macquarie Bank. They are tremendous supporters of Innovation Bay, and in fact the whole startup ecosystem. So yeah, big thanks to them. Give them some love, use their services. Look, before we start today's event, I just wanted to do a bit of a call out. There's, this is number 29 of these Wednesday morning events that we've done. I think March the 20th or something was the first one. So pretty much as soon as the lockdown started and across the country, we started doing these. I think everyone was pretty nervous back then. It was a good place to get people together and bring that community together. We've really enjoyed doing them, but doing it weekly is a little much. So we are going to dial it back a little bit. Just some numbers. We've had 100 guests or thereabouts, which is amazing, including a former Prime Minister. So we had Malcolm Turnbull. We've had some amazing people on there. We've had over 8,000 of you who have tuned in live. And I think almost 7,000 have watched the on-demand videos on YouTube. So we've been putting them up there as well. So yeah, we are still going to do them, but we're just going to dial it back a little. So we'll get 2 more that we'll do before the end of the year, which is pretty exciting. Next event is going to be on the 18th of November, so not a couple of weeks off. And it's about cold email intros. So yeah, if you've ever tried to pitch a VC or anyone actually, it's pretty hard to do it cold. So we're actually going to do a sort of case study of critiquing that. So we've got a panel of investors. We've got Samantha Wong, Dean Durrell, and we're just working on the 3rd one. So that's going to be amazing. So we're really looking forward to that. We do want we're applying or asking for applications, if that's the right word. So if you can send us in your cold intro emails and pitch deck with them, we're going to get our panel to review them in real time and see what their first impressions are and how things can be approached. So we'll probably send out a newsletter on this calling for that. But if you are interested in that, please do it. And then on Wednesday, the 9th of December, we are going to do a physical event in Sydney, and we're going to do a fireside chat. Now, the fireside chat may be remote, but we're hoping to do that in person, depending on who we have. So we're targeting a pretty amazing founder. Normally, at the end of the year, we will put on a big event. So looking forward to that. We'll probably return to Zoom for that, to be honest. Hopin's great, and we do love it. But yeah, we'll be back on here in the new year. Lastly, before we get into this, sorry for going on a little bit, we've got 2 more days to apply for the AgTech for Angels. So we have a fantastic group of angel investors who are looking for AgTech investments. So we would love to get some applications in. 18th of November is the date of it. So 2 more days for the applications to close, and that'll be awesome. And finally, we've got the 100th episode of Open the Pod Bay Doors, which is coming out this week. So Faden and I went back and interviewed I think 15 people last night, our original guests, or many of them, some of the more famous ones. And that was a lot of fun. So we're going to be recording that later today. So that should be out on Friday. So, all right, that is enough from me. So today's topic, look, most business negotiations have, it's high stakes, it's uncertain, you got emotion in it, especially when founders and inventors and investors are negotiating. But how do they get to a point where terms are agreed and a deal gets done? On the one hand, reaching an agreement on a term sheet is about assigning rights, carving out protections, haggling over claims to future returns. On the other hand, these negotiations are fundamentally about picking the right long-term partner and forging a relationship that can survive and monetize the mutually earned successes to come. Most founder investor relationships last longer than most marriages, so it is something you really want to get right because it's pretty hard to unpick. So we're not going to do a usual panel discussion. We've got two amazing guests, a founder and Rory, and an investor. Kind of, although Melissa's back in the CEO seat, so she can she has been around the traps on both sides of the fence. So fascinating insights there. We want your questions, so please ask your questions via the chat. Once the two presenters have given a quick update, then we will jump to a Q&A session, so we'd love to hear that. So on the right of your screen, you'll see the chat window. All right, I have been banging on for way too long. Let me stop my screen share. And we're going to meet the first panelist, founder. Anyway, Rory. So Rory San Miguel, do you want to click the join button and come up on stage while I just give you a quick plug? Hey, Rory. Rory, God, I met you back in 2014 when you just joined StartMate. I remember it was in that dodgy little cafe, and it was you and Francis, and yeah, just so much hunger and hustle and tech chops. I was very impressed with it, and you've gone on and done some amazing things. So, Propeller Aero, you're doing software for high accuracy GPS using drone surveying, mainly used in construction. So you can track large areas of land and investigate hazards. That there's nobody gets endangered during that. You've partnered with global drone leader DJI to sell your software and hardware alongside DJI drones, which is pretty amazing. Propeller, you've got offices in Sydney and also Denmark, which actually I didn't know that. So
Denver,
yeah. All right, look, I'd love to ask you more about Propeller, but we are here to hear about how a founder sees the deal and valuation process. So I'm going to hand the stage to you and let you get on with the presentation.
Thank you, Ian. Let me just get my screen up here.
All right, I'll wait till the screen's up. Right, okay, over to you.
All right, and thanks for having me here today. Always a pleasure, Ian, to be chatting with you and the team at Innovation Bay. So I was asked to put together a few slides on this. I don't claim to be any expert in fundraising. We've done it a few times here at Propeller, which I'll talk you through. But yeah, looking forward to the Q&A after this. So quickly, what does Propeller do? We make 3D maps of construction sites to help them measure their progress. As Ian said, drones are a big part of our business. It's how we do it today. We're working on some other stuff to do it differently as well, to kind of complement that in the future. In terms of the business, we started in 2014. Francis and I, some of you, I'm sure will know Francis. Today, we're a team of 145 across Sydney, Denver, Manila, and the Netherlands. We have about 800 customers across civil construction, mining, landfills, and quarries. So any industries where large earth moving happens, we help them track that earth moving. In terms of our fundraising, we've raised 4 rounds. So 2015, seed round, a seed 2 in 2016, a series A in 2018, and a series B just earlier this year. So you can see the amounts, it's all USD. I've gone and decided to give some color to the kind of leverage, I suppose, that I had or we had at the time. I would say the first round was, we had reasonably good leverage. We had Mr. Rain Ong sort of quarterbacking the investment process for us. So it was actually back at the StartMate pitch day. We would sort of warm up an investor, then flick them over to Rain Ong, who would close them. So if you've got Rain Ong in your corner, it's definitely a good situation to be in. Of course, we blew through that too quickly, almost ran out of money, really rock bottom. The plane almost crashed into the runway. So we had very little leverage in our second round of financing and managed to find a team that sort of took a leap on us, which was great. But worth talking about just the state of affairs there in that round. Then we spent that money much more carefully, and were able to raise a Series A 2 years later with much more leverage. And then I would say again, like we're able to upgrade leverage from the A to the B, and essentially we are able to get better terms for the business earlier this year as a result of a few years of solid growth and some promising sort of business fundamentals. In terms of how I think about fundraising, I've got a few slides here, really 3 principles I think come to mind. The first is optimizing your fundraising is nowhere near as important as optimizing your actual business. And so it's kind of worth considering this as a fringe activity compared to the day-to-day and getting the fundamentals right. I think though it is important, once you're in a position to be thinking about raising, get other people to judge your business that aren't existing investors. I have seen some existing investors try and pull the rug over founders who don't know how good their business is or what position they're in. So I would say like this is a bit of a caveat that I've seen. Number one is optimize your business, spend much more time on that than on the fundraising process. But at the same time, make sure you're getting second opinions on things, and you're sort of trusting people who don't really have skin in the game. Trust them because they kind of act as an impartial perspective in the situation. And it is disappointing to see existing investors try and get away with sort of cheaper terms or get more of the company knowing that it's in a good position. I think that sort of stuff we're starting to see phase out of Australia, but it still comes up from time to time. The second thing for me is getting the right terms at your next round starts now. And just like how a lot of investors court companies, and anyone who's a founder will get, 5 emails a week from random VCs around the world, I think it's really important that companies court investors in return. And it's hard to do this. It's not obvious how to do this. And I think I had some advice from some friend founders who are a few stages ahead of me, which has worked really well, that I figured was a good thing to pass on in terms of getting that leverage. And to me, the best thing you can do is to actually ask them to do real work for you. And the 2 bits of work, or the 3 bits of work really, that we've asked investors or potential investors to do for us in the past is to introduce us to potential customers. And this is really great because they usually sit on those calls and listen to you sell to those customers. And if those customers turn around and buy your product and then are happy with the product, it's this amazing closed loop moment of the investor sort of seeing it all happen. And you're not kind of cooking the books. They've provided the introduction. It's just a random third party. So I think that's a really important one. I think the other great thing to get them to do is to do homework on market, or like the market size or TAM. They've generally employing like hyper intelligent, well-resourced people that can do these things, and they have to do these things as part of their job. So getting them to put that to work for your business is generally has worked well for us as well. And again, I think the caveat is you kind of want to ask them to do things that you have a hunch about. You have a hunch the answer is going to be like good and add leverage to the table. But really, if they turn around and do the TAM data and they realize this is much bigger than they previously thought, that's a really good thing to get them doing. So I think this getting them to do work for you and really thinking of them as a consultant you've got at your disposal is one way to kind of court investors. And it's as simple as only working with the ones that engage, and the ones that do engage, you're not cheating them of anything. It's actually a win-win because they've learned a lot more about your business as having a chance to have spent real time with you, and you've learned a lot more about them and their work ethic and sort of their ability to add value. So I think actually having a courting process as a founder for investors that are keen is really important. And it's almost worth having, like when you're hiring software engineers, you've got a code challenge. I mean, this might be a stretch, but having an investor challenge, and anyone that wants an introduction, you send them back a thing saying, do this and I'll chat to you depending on the answer. I mean, that might be hyper aggressive, but depending on how much leverage you've got and how much time you've got in the bank, then that might be appropriate as well. The third thing here is, once you're in a strong position, that is the most important thing. Again, like all the leverage comes from just generally being in a strong position and not trying to trick people. But if you're in a strong position, then I think you're obviously in a much better chance of setting the terms. And once you're in that position, I think start talking sort of big numbers early, because you'll get met with skepticism. You'll get met with, people saying, oh, no, you're being unrealistic. But I think talking about big numbers are actually a good signal in general. And you know, there is this sort of the right amount of bullish. You don't want to be cocky and arrogant, but you do want to have that, you want to genuinely believe that this business is going places. And so finding the balance there in your language and your tone is super important. But once you're talking about big numbers, if you are kind of growing, I suppose, and revenue is the easiest thing to measure business success off in some ways, but if you are growing, then I do think you end up growing into that number that you've been talking about. And so the investors that you've been talking to will know it's just a matter of time before it's a justified valuation. And that's when I think they generally preempt with a term sheet. So they kind of want to, you know, button it up just before it becomes a really obvious valuation, because, you know, it's a matter of months on their sort of valuation curve, I suppose. So this to me is the third thing from my perspective. It's, you know, don't shy away from the big numbers, and if you are growing, then it is in some ways a matter of time before that big number now makes sense. And that's it. That's my three principles, I suppose, or some of the things I think about when we're going to raise. And I suppose really fortunate at Propeller that we've had the pleasure of working with some really good investors, and those investors have supported us over many rounds. And so actually going out to the market and doing the sort of the Sandhill Road trail isn't something I'm super familiar with, but generally speaking, we've been able to get these fundraisings done.
Rory, that was terrific. Thank you. Some amazing insights there. And looking, it's great hearing that from a founder who's been there, you know, because you didn't come from that investment background. You've learned on the tools. So look, I got a few questions that'll come in, but the audience will too. So if I could ask you to get off into the and then we'll get out, and then we'll get you back after Melissa. So Melissa's turn. So Melissa, if you want to click your join whilst I introduce you. So Melissa's an experienced founder. In fact, she's just been on the podcast. So if you tune into that, you can find out all about Melissa and our innermost secrets. Experienced founder, CEO, investor, and board member. You're now CEO at Lighter Capital. So slight conflict of interest. Melissa and I are doing some work together. So I've been helping Lighter get set up in Australia on the side. Lighter's pioneer and leading provider of revenue-based financing to SaaS companies and a few others, but mostly SaaS. Prior to Lighter, Melissa was managing partner at NAB Ventures. Before that, Seapoint Ventures. Before that, Seven Software, which she sold successfully, and Northwest Supply, going back a long way. In 2010, not that long, of course. In 2010, Melissa co-founded Heads Over Heels, which is an amazing organization that works with female entrepreneurs and helps them get better connected, I suppose, is the punchline. So it's, you know, you've helped a lot of companies through that, including some pretty amazing ones. So Melissa, welcome. It's great to have you here.
Thank you. It's great to be here, Ian.
Yeah, no, it's good. Yeah, anyway, look, why don't I throw over to you if you want to share your screen, if you've got any slides, and I'll give you the floor to talk about this topic.
It takes a couple minutes for the slides to come up.
I'll stay here and give you moral support while you.
How's that? Can you see that?
No. Yeah. There we go. It's just loading, and then there we go. Yeah. So if you full screen that, then I will get out.
Thanks, Ian. Well, and I'm really glad to be here. And in fact, this is one of my favorite topics to discuss. And I love discussing it now that I'm sitting in the CEO seat and not in the venture seat, because I give the same advice I would give in both roles. But I think it was always a little bit suspect when it's on the venture side. But this is something I've been saying pretty consistently for a couple of decades now. So I'll start with who sets the valuation when you're raising from angels or friends and family? Because it's typically two different paths, and there's always exceptions, but these are very much generalizations. So when you're when you're doing a small angel round or friends and family, and especially when I say a small angel round, meaning there's maybe multiple angels, there's not one large angel setting the terms, then you should be prepared. The entrepreneur should be prepared with a specific valuation as well as a range of terms, or a valuation range as well as the specific terms. So typically angels and your friends and family, they'll want you to come with the terms. And this is where I've seen entrepreneurs make some potentially what can be fatal errors. So they'll go out to, relatively maybe not super experienced or sophisticated investors and go out and raise money at a valuation that is really not appropriate for the stage. And, they're able to do so by pointing to, if the company is successful, it could be worth hundreds of millions, $1 billion. So, buying in at an early round for, say, 10 million sounds like a good deal. So I've seen companies do this often where they raise at too high a valuation at an early stage. And then what can happen there is that it makes it very difficult to get your next round. So your next round, which would presumably be from maybe venture capitalists or some more sophisticated investors. So I would advise entrepreneurs to really think about their valuation as a continuum and not an endpoint, because the reality is the only valuation that matters is the one that when you sell your company. Before that, those are just steps getting you to that liquidity event. And if you choose the wrong valuation, or if you end up with a high valuation, that makes it very difficult to get your next round, because no one wants to do a down round. Your current investors don't want to do a down round. New investors don't want to come in and put a down round on the company. So it can make it very difficult to get your next round of financing, and therefore just put a lot of risk on the company as a whole. And a piece of advice that I received really early on when I was raising money on Sand Hill Road for 7 Software. It was actually from a guy named Doug McKinsey at Kleiner Perkins, which was the top firm at the time. It's still a top firm. And he had said, when I had asked him, we were talking to him about potentially investing in 7 Software, and he had told me, Melissa, you should focus more on the quality of your partners and not be concerned about valuation. And I remember leaving that meeting and thinking, gosh, he must think I'm really naive. But it was actually just spot on advice that, when you get focused on valuation and choosing the investor that's going to give you the highest valuation early on, or even in the mid stage of a company's life, it's absolutely the wrong thing to focus on. The only valuation that really matters is the one at liquidity, and you should focus on getting the best partner that's going to help you grow your business. On the venture side, it's a little bit different. I mean, the last point I made still absolutely holds true. Find the best partners that will help you grow your business. Don't just chase the one that's going to give you the best valuation. But VCs will want to understand your funding history when you go in to have a discussion with them. If they ask you, what are your valuation expectations, I think the best answer you can give them is, we just want to find the best partner. Valuation isn't the biggest concern for us. Our last round was X. Maybe we're hoping to have a step up. You don't even need to go there, but just, if you tell the venture capitalists you're just looking to have the best partner that will help grow your business, you will end up getting the best valuation and the best partners. The worst answer is to really seem stuck on valuation. And that's not because the VC, and I've spent time on both sides. I've spent almost 2 decades in venture. It's not so much that the VC is trying to get the best valuation at that time. I mean, they're trying to get a lot of times a meaningful percentage ownership of the company, but it's trying to get the right valuation so the company is set up that even if they have a couple hiccups, they're setting themselves up for an up round next time and setting themselves up to be an attractive investment for the next round of venture capitalists that come in, or the next round of funders that come in. And this goes back to a previous point, which is you've got to think about funding as a continuum, not a point in time. So again, best answer is just looking for the right partner. Valuation isn't our focus today. Want to get the right partner to help grow the business. And that's when we talk about negotiating tactics. The reality is, you'll be in the best position if you have multiple investors, multiple VC firms wanting to invest in you. That's the way to get not just the best valuation, but really the best terms and the best partner to help grow your business. And those are my high level thoughts on that topic.
All right. Sorry, it just took me a couple of seconds to get back in there. Thank you. That was great. So Rory, I might ask you to come back up on stage here as well, and let's just have a quick chat around that, because I think there's some really good topic coverage there. One question that I don't think you addressed, which is around the notes or convertible notes. And it kind of it sort of seems a bit like a way of dodging the valuation question. So, Melissa, I might ask you that one. I mean, what's your view on safe notes or convertible notes as a venture raising instrument?
Well, I think they make sense if you are close to a round. It can be problematic, if you're close to a bigger round and it is really just a bridge. They can be problematic if they're going to sit there for a very long time, if a round's not going to happen for a couple years. But then, because then what you have to do, you have to do this anyways, you're going to have to put some kind of some kind of floor in, and that sort of sets a valuation anyway, or future valuation expectations anyway. So I would say it makes sense when there really is a another valuation, when there is another round in the near future, sort of under 6 months time.
Yeah. All right. Look, there's a couple of questions already come in. So in fact, there's a good one from Harold Dimple. So I might ask that to Rory, because the perspective. Propeller is, by all accounts, a great company. You came out smart. You've done all the right things, and you engendered that competitive tension into the process. And Melissa touched on it too. It's the best way to negotiate is if you have options. Harold says, what if you have no leverage or bargaining power? You're on your knees and you desperately need the cash. What are the most important things to think about there? A smaller raise to keep you afloat. That's all he asked, but does the other question give up? Any tips for that, Rory? Even though you may not, I'm sure you've seen it before, even if you haven't been in that situation.
Oh, we've been close. We've been really close. That second round was not pretty. I suppose you're still looking for believers in the business, and I think back to Melissa's point around finding the right partner. It wasn't a keep dropping terms until someone would say yes. It was who gets this and who gets the challenge and who can kind of put the challenges that we've had in perspective, and then let's work on a fair price with them, knowing that there's actual mutual sort of a desire to work together. So I don't really feel like I've got a good answer for not. If you've got no leverage, you've got no leverage, right? You either pack it up or you take what you're given. If that's literally the case, but even in our case, when it was kind of rock bottom, we still had Nikki at Blackbird, back us and sort of give strong references and commit to the round before anyone else had. So there was still some positive elements that we could leverage. So I think from my perspective, I think no leverage is a very dire situation, and generally, you always want to be finding some leverage.
And Melissa, from the investor's perspective, I think it's fair to say most investors will not want particularly to be taking advantage of that, because bringing the company to its knees and trying to wash out the founders and in equity, taking too much equity than you otherwise should is counterproductive. Do you want to touch on that and the way an investor might view that?
Yeah, absolutely. The founder, typically in those situations, it's the founder isn't the one that gets hurt the most, it's previous investors. Because if the founder doesn't have enough skin in the game, they're not going to be motivated to do the hard work, and the chance of the company succeeding, assuming it is dependent on the founder, is really low. So I would just say to that person, just get the right person on board. If you bring the right person or right group of investors, if you bring the wrong investor in and somebody is looking to take advantage of that situation, that's potentially a company killer down the road. So focus on, I agree 100% with what Rory said, focus on somebody that, gets and shares your vision and wants to build the company.
Yeah.
You know, that interim valuation step isn't, isn't the end game.
Sure. All right, look, keep your questions coming in, and we'll try and get to them. But we've probably got another 10 minutes before we'll jump into the breakout room. So, Rory, like you came from, I mean, you were not an expert in fundraising when I met you back in 2014. I think you and Rory were just learning, but you had a huge capacity for. I mean, this is a trait of a great founder: huge capacity for being curious and wanting to learn. Oh, my dog has just come out of the shower, so she's going nuts here. Yeah. So, how did you learn the tips and tricks for fundraising?
I think StartMate was a really good place to kick off the business because of its ability to get people up to speed on, even the lingo. I didn't know what a term sheet was or ARR. My girlfriend still jokes that it's MMR, not MRR. So there's all this stuff that you kind of come into this world with no concept. It's not taught at university. So StartMate really is a great place to get a feel for a term sheet and get a feel for the advice that you'll get from the other side of the table. So we really appreciated that. And we actually did StartMate twice, once with Flirty and once again with Propeller. So we had plenty of that. And then I would say, our fundraising story we've never... we've worked a lot with Nicky at Blackbird. He's been our main backer, and it's never been this combative, sharkish world that kind of people talk about. It's just conversations, and it's respect, and neither one of us are trying to trick the other. It's like we're both striving for win-wins, and so it's been a very natural learning process. I think working with Nicky directly, and then at the same time, there's a few companies in Australia that are obviously trailblazing ahead of us, and so they've been very really useful sources of advice for me. So yeah, I really appreciate the other startups in Sydney and StartMate, and just kind of the general attitude of Blackbird. It's been very useful.
Melissa, any thoughts on that one? Like, what do you advise founders when they may not know as much as you would think they should?
Just to talk to as many people as they can. I mean, I 100% agree with Rory that it's not this, it's not an adversarial relationship, you're getting into a marriage. So when you go to sell your company, that's the end. That's where you just get as many, you get as much as you can. There's not that there's a winner and a loser, but there's just a certain size of the pie, and you want to get as much as you can when you're selling it. But when you're building that company, you just want to get the pie to be as big as possible. So you think about, you're going into a marriage, not a divorce, and that's the way you should approach it.
All right, terrific. All right, another question has just come in, which looks pretty good. So Zain Kazi, what is your approach to terms such as investor veto rights at the different raise stages, and founders having to give up rights to control an exit event? So I guess the question is really around, and also founder. That's a question that often comes up when we're talking to founders. So I mean, there's a few things in here. So Melissa, I might ask you this one first, and then Rory.
Yeah, so it's pretty common in the U.S. for each round to have to have some veto rights over a subsequent round, or potentially even a sale. But what you want to do is, and assuming that you've got good relationships with investors from all the previous rounds, and assuming there are previous rounds, is you want to get that into you want to get that into a structure where, in order to veto, say, an acquisition or a future round, you would want to have a majority of the preferred, or the majority of the investors, maybe even 75% of the investors, have to agree to that. And it's an important term for investors to have going in. If you think about, you're putting in your capital, which a lot of times is other people's money that you're managing on their behalf, and you want to have the right to, as an investor, make sure the company doesn't, turn around and sell for nothing the assets to some. You want to have some control over what happens on an exit, and you also want to have some say over what happens on subsequent rounds. So it's not an uncommon term, but I would try and just make sure that, especially if you have previous investors, that you have a structure where a majority will have to agree to, either blocking something in the future, in terms of blocking something in the future, in terms of an acquisition or a future round.
Yeah, and Rory, I mean, were any of these terms? I mean, how hard did you have to negotiate to get out? Because a lot of, there's a lot of terms in an agreement, but there's only a few of them that actually count. So, what were the ones that you focused on that counted from the founder's perspective?
We've raised very vanilla financing rounds, so I'd caveat our discussion with that. I think founder investing is super important. I don't think that's an investor sort of geared, term, to be honest. I think it's there for the company in many ways. Like, you never know what's going to happen. And so just having a very fair and agreed upfront investing schedule that makes sense. It's easy to agree those things when you don't need it. It's very hard to agree those things when you need it. So I would say that that's a point in the favor of business, not so much like the venture team. And then otherwise, when in the times when we've had slightly more leverage, we haven't really pushed too hard. And again, I don't see it as the adversarial thing. We've just got vanilla terms to make it easy for us to raise capital and make it a fast process and make it easy for other investors to come aboard. There's nothing spooky on our cap table or our previous term sheets. The one thing maybe we've tried to do is bundle all of the preference shares into one class of shares. That I suppose has some advantages in some exit scenarios, but really that's as much as we've pushed. And I've never needed to go to the shareholders agreement on a board meeting. It's never come up from a founder control perspective. There's not, again, it's a relationship, set of relationships based on just respect, not on the legalities of it all. Yeah, no, that's a fair point. All right, look, a couple more questions and then we'll maybe jump into the breakout room. So Lance Chia, for Melissa, does your view of valuation at exit, so I think this is the point around the only valuation that counts as your exit, does that change if your intention is not to sell, rather grow a global successful and competitive business that happens to be based in Australia? How does it change then?
Well, if you are taking investors' money, then your goal is to sell. So unless you have investors who just say, I want to put my money in and just hang out forever, right? I mean, if you're taking investors' money, your goal is to sell. And that doesn't mean it's not to build a big company that will go on, in perpetuity, because the exit might be an IPO. And in that case, you're selling part of it to the public. So I'm not sure, what the question is trying to get at, because once you do take investors' money, there is an implicit agreement that you plan to sell the company, whether it's to the public or to an acquirer in the future.
Yeah, no, I think that's spot on. And eventually, people are going to investors need liquidity, and there's a trend around secondary sales coming in, but again, that doesn't solve any of this problem. So eventually there is likely to be an IPO or an exit in any equities transaction.
I want to quickly comment on this. Actually, one thing I've noticed, so there was a period of time where Propeller was, I would say, undervalued, and the problem with that at the day-to-day level for me was in equity grants to new staff. If you can get your business sort of frequently valued, I suppose, and that value is going up, then staff understand the appreciating value of the equity, and future grants cost the business less and are sort of worth more on paper. And so I would say the intermediate rounds are important to get right if equity is a big part of the kind of package that you're offering and your staff are excited by that. So that's probably my only comment on the purpose of sort of pricing the right middle rounds. Yeah.
Slightly related to that, and we'll probably make this the last question before we jump in, from Kim Chandler-McLeod. Hey Kim, when the founders own more than 80 to 90% of the company, are investors less interested as they may have less control as to how decisions are made? Melissa?
No, and the control doesn't come in necessarily from owning, 51%. It's the other terms that are in place. But investors would probably, in general, sophisticated investors be hesitant to come into a company if they're looking for high growth with founders whose main concern is just owning a big chunk of it. Because if you're, there are very few examples of companies that have gotten really big that haven't, sold equity along the way, where a founder's gotten to a position where they've owned, a minority stake. You could count them on one hand. So I would be more concerned, as an investor with, do you want to grow a really big business? And if your focus is, and I've seen this, before, and these companies typically don't grow very big, with founders that just don't, want to, dilution is their main concern. And like I said before, it's just hard to grow a large company without capital. So you're probably going to have to sell rounds along the way, unless you go to lighter capital and want to fund the company through debt. And we actually have a lot of examples of companies in the lighter portfolio that have never raised any outside capital because they didn't want to, and the founders owned 100% until they got to either an exit or a much larger round.
Yeah, because we haven't touched on debt as an instrument in this, but it's becoming more relevant and valid. There are new entrants in the market like lighter. Because historically debt has not been an option because banks would lend to you, but you'd have to put your house in the line.
Right.
Whereas I don't think that's the case now. So.
Yeah, absolutely. So if dilution is a concern, there are other avenues.
Yeah, Kim just made a good point. I keep calling her the wrong name. I call her McLeod rather than McDonald. Sorry, Kim.
Okay.
Forgive me. Right. On that note, I think we will jump into. So thank you, Melissa and Rory. That was very insightful. And yeah, thank you also to the audience. There were some great insights going on there in the chat room. Why don't we jump into the breakout sessions? So. In fact, before we do that, let me just check that I've got the run sheet right, because this is slightly different to normal. I may need to do something. No, this is what we're going to do. So in breakout room 1 is going to be me and Rory. So we'll sort of keep things ticking along. This is designed to be interactive. So when you come in there, you can join in. If you've got a case study you want to put to us or have a direct question answered by us, it's just going to be a bit more casual way of answering it. Rory and I are going to focus on seed and series A. And then in the second session's breakout room, we're going to have Melissa and Faden. So hopefully Faden knows how to get in here. Of course he does. And they're going to be talking about later stage alternative fundraising and non-seed and Series A. So if that makes sense, I think we should all get off the main stage and we will see you in the sessions. I don't think the networking has been switched on yet, but we'll maybe do that once we've done the session. So, Rory, do you want to join me in session room 1? And Melissa, if you get out here, we'll see you in session room 2.
Okay, great.
Thanks.